now, we have the highest estate tax exemption that we've ever had in history. And that's the $11.7 million per person. Now, if you're married, you can double that and you have a $23.4 million exemption before you have any estate tax exposure. And the tax rate that we pay estate taxes, that has been steady at 40% for several years now. We still have the step up in cost basis at death. And I'm going to go into a little bit more specific on that here in a few minutes. We have the marital and charitable deductions. And the charitable deduction is an example of why people like Bill Gates and Warren Buffett will pay little or no taxes. I mean, they're very powerful tools to minimize or even get rid of estate taxes. We still have valuation discounts, so you can leverage gifting with valuation discounts. Spousal portability is also really nice. And that's a technique that allows one spouse to give essentially their $11.7 million exemption to the other spouse, but only if your estate plan is structured properly. And then as far as just annual gifting, we have the $15,000 per person per year that you can give. And there's unlimited payment of medical and education expenses, as long as those payments are made directly to the hospital or the school. So I want to show you a couple of graphs that further illustrate the estate tax situation. Here you can see the estate tax exemption going back to 2000. And right now it's the 11.7. And if for some reason they don't make any tax changes, if there is no reform in the tax code, that exemption will continue to ease up with inflation adjustments until December 31st, 2025. And that's when it's set to expire, or they call it sunsetting. So what that means is on January 1st, 2026, which is all the way over there on the right on the column, the tax rates and tax changes will go back to what they were in 2017, which is the $5 million index for inflation. So that'll be a little over $6 million. So on this next graph, what I want you to look at is the orange line, and that represents the tax rate, the rate at which you pay estate taxes at. And as I mentioned, it's been steady at 40% for the past several years. And in 2009 and 2010, you see that sharp dip. That's that crazy year that we had where there were no estate taxes. So depending on how much you read and look at the news and listen, there's a lot of talk about estate taxes. So I was curious to see what percentage, where does the federal government get its revenue from, and what percentage of that is estate taxes? And you can see here that the majority of the taxes comes from individual income taxes. The dark blue is the corporate income tax. Then there's the Social Security or payroll taxes and some excise taxes. And then you have this other category. And estate taxes are in this other category. And it may surprise you to know that less than 1% of federal revenue comes from estate taxes. So there's a very small slice of the population that actually face this, but that doesn't make it any less serious for those of you who have taxable estates or borderline taxable estates and have a potential estate tax situation. So what has the current administration said that it wants to do with respect to estate tax reform? Well, the Biden administration has said that they want the estate tax exemption to go to historical norms. Well, if we look back at history, that means probably $3.5 million per person, which coincidentally is what the rate was in 2009. The tax rate would go from 40% to 45%. And this next bullet point is really what scares me the most. They want to do away with the step up in cost basis. And if you're not sure what that is, one of the duties and responsibilities of your executor when you pass away is that they have to value and appraise all of your assets as of the date of death. So that includes things like getting appraisals for all the real estate. Every stock and bond that you own has to be valued. Business interests, personal property, cars, everything needs to be valued as of your date of death. And the nice thing about this cost basis step up is that every asset then gets a fresh new cost basis, which is that value on your date of death. And what that means from a tax standpoint is that all of the unrealized capital gains that you've had from that point back are wiped out. So that's a huge benefit of just doing away with a lot of capital gains. And if they do away with the cost basis stuff, I think that we're going to shift from doing estate tax planning to doing capital gains tax planning. So that'll really shift the way that we look at tax planning for estate planning. All right, so before we get into some specific techniques, I wanted to give you a couple of foundational pieces of information about estate planning. So here, what I want you to see is that there's two levels of estate planning. There's standard estate planning and there's advanced estate planning. And standard estate planning is something that everyone on this call, whether you have a $100,000 estate or a $100 million estate, all of us should have standard estate planning. And this includes things like wills, revocable trusts, medical and financial powers of attorney. And then once you get those in place, that's when you can look at your assets, the complexity of your estate, and to what extent you have estate tax exposure to see what, if any, advanced planning techniques that you might want to employ. Here's another representation of sort of that planning continuum. I would say that if your estate is anywhere in the $0 to $10 million range, pretty much standard estate planning documents are going to take care of what your needs are. Once you get bumped up to the next level, the 10 to 25, that's when you obviously need standard documents plus consider lifetime gifting. The goal of lifetime gifting would be to lower your estate value to where there's either a lot less or no estate tax exposure. 25 to 80 million standard lifetime gifting, but you're pretty much going to have to employ some advanced techniques to get where you want to be from a tax standpoint. And then once you reach the 80 million plus level, that's a totally different ballgame where you're looking at family governance and legacy planning. So what I want to show you here is what a standard or typical estate plan looks like for a married couple. I would say that over 90% of married couples who have a fair level of wealth have some version of this estate plan. And on the left, you can see the medical and financial powers of attorney, the living will. Those documents allow someone that you appoint to make medical and financial decisions in the event you're disabled. And then the estate plan typically includes what we call pour over wills into revocable trusts. Here you can see the husband and wife each have their own revocable trust. And then upon the first death, regardless of who dies first, typically you see two trusts created. And the two main reasons for these trusts are tax purposes, but also what we call creditor and creditor protection. This bypass trust, the gray box, which is otherwise known as a credit shelter trust, you might have heard it referred to that way. Its purpose is to receive the estate tax exemption amount of the first spouse to die. So with the $11.7 million amount we have now, if let's just say one spouse dies and they have a $15 million estate, what that means is the first 11.7 would flow into this bypass trust and the balance would flow into this marital trust. And the nice thing about the bypass trust is if the surviving spouse lives, say another 10, 20, 30 years, and that amount that flows in there doubles or triples in value, the entire amount will be exempt from estate taxes. So that's where that credit shelter term comes from. It shelters the estate tax credit amount plus whatever it grows to. And then you have that creditor-predator protection if there's a lawsuit, if there's a disability, or if there's a remarriage and another spouse, there's protections from all of those things as well. And in this plan, when the second spouse dies, we have everything flowing to 4 children. And here you can see that they're each getting 25% also in trusts. And then children's trusts can also have tax benefits and creditor-predator protection. And whether you leave your children's inheritance to them in trust or outright is a family-specific situation that we would need to look at. Now, don't get intimidated here. Don't worry. I'm not going to go into any excruciating detail of this diagram, but I wanted to show this to you for 2 reasons. Obviously, this is a diagram of a much larger estate that has employed numerous advanced estate planning techniques. But on the left, kind of scrunched up there, you can still see that standard husband and wife estate plan that I just showed you. That's still the basic thing that you have to start with. But the first thing that I wanted to point out is there are a lot of entities here, and each one of those entities has to be managed. They file their own tax returns. The assets have to be managed separately. So whenever you start employing advanced techniques, you get a certain level of complexity that goes along with it. And you have to be willing to take on that complexity in order to reach the tax minimization goals that you might have. The second thing here is at the bottom, upon the second death, the kids, which are 2 kids in this example, are going to get everything in trust. And depending on the size of the estate, there could be up to 12 trusts, 6 trusts for each child. So the other thing to consider is somebody has to manage all of these trusts. And that's why it's important to look at what your fiduciary selections are. Who's going to be the executor, who's going to be the trustee, and who's going to manage this. So balancing your desire to lower or minimize taxes with complexity is really one of the things I wanted to point out here with this slide. All right, so let's roll up our sleeves and start getting into some specifics. How can we save both estate taxes and income taxes in light of potential tax changes or potential tax changes that are likely to occur? Well, annual gifting, that's that $15,000 per person per year, is still a really good way to reduce your estate. And I'm going to show you a specific example of that here in a couple of minutes. Now, if you say, okay, I want to give more than that $15,000, that's when you're really talking about lifetime gifting over and above the $15,000. And a lot of times what that involves is pre-funding those children's generations giving trust. Those are those 4 blue boxes, or in the second example, the 12 blue boxes at the very bottom that I showed you. So that would be more significant lifetime gifting, where you're actually using up some part of your lifetime estate exemption. The next item is what's called a spousal lifetime access trust. And we like acronyms in estate planning, so that's called a SLAT. And I have seen more SLATs created in the last 2 years than I have seen in my entire career. And that's because of this looming specter of potential higher estate taxes. And I have a specific SLAT example I'm going to show you also here in a minute. Low basis assets. So a lot of people have assets that have appreciated substantially, but have a low basis. So that what that means is they have this huge capital gain that's unrealized. And if one of your fears is that they're going to do away with the cost basis step up, which we talked about a couple of minutes ago, then charitable options with low basis assets are really good opportunities. And on the next slide, I'm going to give you several examples. Roth IRA conversions. Similar to SLATs, I have seen more Roth IRA conversions in the last year and a half than I've ever seen. So as you probably know, when you take distributions from a standard IRA, those are taxable to you. But distributions from a Roth IRA are not income taxable. So what a lot of people are doing is they're converting their standard or traditional IRAs into Roth IRAs because they think that tax rates are going to go up and they'd rather pay the lower tax rate now. And then lastly here, we have irrevocable life insurance trusts, commonly known as ILITs in the estate planning world. And this is a technique that has been sort of dormant on the shelf for many years. And the reason for that is because the estate tax exemption is so high. In a lot of estates, life insurance policies represent a significant asset. And life insurance trusts allow you to get those policies out of your estate for estate tax purposes. So it lowers your estate tax base. And those life insurance proceeds can be available to pay estate taxes if there are any. So let's look at some specific charitable opportunities. So obviously you can still make direct gifts to charities, either cash or assets. But another popular technique is a donor advised fund. This is a fund that you create, and the nice thing about this is it gives you flexibility. So for example, if you created a donor advised fund in 2021 and funded it, you would get your income tax deduction for the 2021 tax year. But there's no deadline on when you need to make distributions out of that. So you could wait till, say, 2022 to start making charitable distributions out of that donor advised fund. Charitable remainder trust. So this is what I like to call your have your cake and eat it too estate planning technique. So if you give money to either a charity directly or a donor advised fund, once you part ways with that asset, that's it. It's no longer yours. It's the charity's. But with a charitable remainder trust, you get to have your cake and eat it too. So for example, if you were one of the lucky people who bought, say, Apple stock soon after it went public, and now it's increased several thousand-fold, so you have this huge unrealized capital gain, imagine contributing that Apple stock to a charitable remainder trust. So what happens then? So number one, you get an income tax deduction for that charitable distribution. Secondly, when that charitable remainder trust sells that Apple stock, neither you nor the charitable remainder trust realizes any capital gain. So the capital gain is basically a moot point. The charitable remainder trust then diversifies that into a portfolio that's no longer a concentrated asset, which that Apple stock was. And then that charitable remainder trust pays you an income stream either for your life or for a period of years, whichever one you choose. So that's the key difference with a charitable remainder trust. You get that income stream for life or a period of years. And then lastly, that Apple stock is out of your estate for estate tax purposes. So you've lowered the value of your estate and are hopefully paying less estate tax. If your estate is large enough, then you can consider creating a charitable foundation. And then beneficiary designations of qualified plans and IRAs. So retirement accounts are what we call toxic assets when it comes to estate planning. What do I mean by toxic assets? So if you have a taxable estate, your retirement plan would be subject to a 40% estate tax. If that retirement plan then passes to a beneficiary that's, say, in the 30% tax bracket, potentially 70 cents on the dollar of that retirement plan will be subject to tax. I think we can all agree that's a very undesirable result. What if instead, assuming the beneficiary didn't need that retirement plan financially, what if instead you named a charity as the beneficiary of that retirement plan? Well, number one, your estate would get that charitable deduction. And number two, that the charity would pay no income tax. So that's a really good option for retirement plans. Again, low basis assets. We already talked about the charitable remainder trust with the Apple stock, but it could also be other assets. Say that you inherited a piece of property from a relative a long time ago, and because of the location of that property, it's appreciated substantially in value. You can also give assets like real estate to a donor advised fund or a charitable trust. And then lastly, qualified charitable contributions from an IRA. So if you are in minimum required distribution status on your IRA, you can allocate up to $100,000 of that distribution to charity. And the nice part about that is whatever amount goes to charity, you are not income taxed on that. So that's, if you don't need the full distribution to live on, that's a good way to lower your income tax bill. All right. So I'm going to give you another example of how to lower or even eliminate estate tax. And part of that is asking me a little bit more of a philosophical question. And that is, what's the right amount of inheritance to leave to my child or grandchildren? And what I mean by that is, when I ask this question with a lot of clients, what they tell me is, Scott, I really don't want to dampen my child's motivation or ambition. I don't want to turn them into a trust fund baby. I got to where I am with hard work, blood, sweat, and tears, and failing and learning from those failures. And I just don't want to take that away from my children. So, what's the right amount of inheritance that'll provide them, say, a financial security net, some retirement security, but it won't dampen their motivation and ambition? Well, if you can get your head around that type of thinking thought process, then you can have kind of what this next example is. So imagine that you have this $10 million estate, And let's say the estate tax exemption has gone down to 3.5 million. What would happen next if you died is that your executor would write a check to the IRS for approximately $2.5 million. I think that's a lot of money to give to the government personally. What if instead in your estate plan, you had a formula that said, when I die, I leave the largest amount that can pass free of estate tax to my children. Well, we know the largest amount that can pass free of estate tax is that 3.5 million. And the rest passes to whichever charities that I designate. Well, what have you just done with this formula? You've given each child an inheritance of $1.75 million tax-free. Your estate received a charitable deduction of $6.5 million, and the US government received $0. So again, just asking that question, what's the right amount of inheritance, might give you some more ideas with how to structure your estate from your kid's standpoint and also reducing tax. Here, I just want to, again, just hit on the power of gifting. I know almost everyone gets this, but when it comes to direct gifts or irrevocable trusts or even gifting using discounts, we can't underestimate the power of gifting. So in the middle example here, let's just say that you gave 1.5 million this year to an irrevocable trust for your kids. If that grew at 7%, in 10 years, that would grow to about $2.9 million. In 20, 5.8 million. And if you died at that 10-year mark, your estate would save $1.18 million in estate taxes, just through that compound interest in that and how that asset grows. So we can't underestimate the power of gifting and the power of compounding. This is that example that I promised you about the annual exclusion gifting. So in this case, the husband and wife can combine their 15-year per person per year amounts for $30,000 per person. And here they have 2 children that are both married, and they have 4 grandchildren in total. And there's also a brother and a father that have some financial needs. So if this husband and wife gave each of these people $30,000 a year, they could give a total of $300,000 a year gift tax-free. Now, obviously, you'd have to run a cash flow analysis for yourself to see how much you can give away without affecting your cash flow negatively. But if you have time on your side, you can do this for many years in a row. There is a lot of money you can get out of your estate and lower your estate tax exposure. So lastly, I wanted to show you this spousal lifetime access trust concept. And to kind of take the mystery out of it, I wanted to show you the standard husband and wife estate plan one more time. So you remember a few minutes ago, we talked about this bypass trust or this credit shelter trust. So if Jane and John wanted to create a SLAT, what they're essentially doing is creating this credit shelter trust now instead of waiting till when the first spouse dies. So let's just take Jane. Let's say Jane wants to create a SLAT for John. What does that look like? So Jane would be the grantor spouse, and then she decides which of her funds she's going to use to fund this SLAT. Now, it's important to realize that a SLAT is an irrevocable trust. So as opposed to a revocable trust, once you fund an irrevocable trust, you can't take the money out anymore, and you can't change the terms. So once Jane creates the SLAT for John, John's the non-grantor spouse beneficiary. And one of the reasons why so many people have done SLATs in the past 2 years is because Jane, as the spouse of John, gets indirect access to the SLAT. So every time John receives a distribution, Jane benefits from that. Now, every estate planning technique has a downside. And the downside of a SLAT is that when John dies, the SLAT passes to the children, which are the remainder beneficiaries. So the danger is, there's an accident or some unforeseen event and John dies sooner before his life expectancy. And that's why it's so important for Jane to really, from a funding consideration standpoint, to make sure that she funds that SLAT with only enough assets to leave her what she needs to live on comfortably if John were to die sooner than expected. So just to kind of recap what we've been talking about, there's 4 main things that I want you to take away from this discussion. So first of all, the size and nature of your estate is really going to determine what, if anything, that you can or should do from a lifetime gifting standpoint, selling assets, making charitable contributions. Really, your specific situation is going to determine what, if anything, that you should do. The second thing that you have to weigh is your desire to pay less taxes. For some people, that's really important. In other people, it's not much of a consideration. So it's really finding out where you are on that spectrum of wanting to lower taxes. The other important thing to realize is that if you do any lifetime gifting, what you're essentially doing is accelerating the inheritance that your children or grandchildren are going to receive. And there's definite pros and cons to that. And the last thing that I want you to consider is your appetite for complexity. The last thing that we want to happen is, for you to employ some advanced estate planning techniques, and then 6 months or a year later, for you to have buyer's remorse and say, God, I wish I didn't do this because this is really complicating my life. So there's really several things to consider and juggle to see if lifetime gifting or any type of technique, advanced technique, is right for you. And a really good way to start is if you have a taxable estate, or if you think you have a borderline taxable estate, if the tax rates go down, is get some help with running an estate tax calculation. And your financial advisor can definitely help with that to see what your estate tax exposure is. So those are the main thoughts that I wanted to leave you with. And with that, I'll turn it back to you, Jude.
Awesome. Thank you so much, Scott. There's really some incredible content here. And I think, these conversations that we're having around estate planning are so incredibly important. And I really do feel like the education on these certain topics is really an area where there's a great opportunity. There's so many complexities when it comes to estate planning and so many different techniques. And, I think you did a really great job at showing all some specific considerations and whatnot. And I think that's a really, really powerful tool to have. It's just the education itself. We did have a couple questions that came in. Now, with respect to the SLAT, the SLAT, so it's designed to receive a person's estate tax exemption amount. Will there still be a credit shelter trust created upon the first death if the SLAT is created?
Whoever asked that question is very, very, very insightful. That is an excellent question. So here's the slide again with the SLATs. So if Jane decides to create a SLAT for John, the most that she can put in there without any negative tax consequences is her full $11.7 million, right? Now, obviously, her estate would have to be really large for her to comfortably move that much money into a SLAT. But if she said, you know what, the right amount to put into a SLAT right now for me is $5 million, then there would be a credit shelter trust upon her death. And just the amount between 11.7 and 5 million, that's what would go into the credit shelter trust. But if she put the full 11.7 in, then there would not be a credit shelter trust because she used up her whole exemption. So that was a really good question.
That's great. Thank you. Here's another question that came in. Can the proposed Biden tax law changes be retroactive to January 1st of this year if they're approved later this year?
So while that is theoretically and also constitutionally possible, the consensus in the estate planning community is that it's extremely unlikely, especially as we get further into, moving towards the end of 2021. It's going to be very difficult, if not impossible, for them to do that. So, our prediction is that if there's any tax changes, the earliest that they would be effective is January 1st, 2022. But that's if that whole, negotiation process in Washington actually works and they can come to an agreement and a resolution.
Right. Which we all know that's always up in the air.
That's right.
Great. Thank you. Here's another question in regards to the SLAT. So who pays the income tax on the SLAT after the grantor's death?
Another good question. So most SLATs are structured to be what we call grantor trusts. So what would happen is Jane would set that trust up so that she would be the taxpayer for the assets in the SLAT. And since both spouses benefit from that SLAT anyways, it really does not make much difference if the trust pays it or if she pays it. If the trust pays it, that just means there's less money for the kids going forward. So that's by her paying the income taxes of the SLAT, that's actually making a further gift to the children by removing that burden from the trust.
Great, thank you. Now, in your example of the formula with the quote unquote right amount of inheritance, can you decide to give more than the estate tax exemption amount to your children?
Absolutely. And this is a really family specific topic, right? Of what the right amount of inheritance is for your children. So in my example, the exemption was 3.5 million, and split in half, that was 1.75 million for each child, I think. So if you said, you know what, the right amount of inheritance for each of my kids is 2.5 million, that's fine. All that means is that there would be some estate tax due upon death. And it's really interesting, Jude, when I talk with clients about their estate tax exposure, and I show them the number, this is how much estate tax they would pay if you were to get hit by the bus. There's really kind of two extremes that I see. Some clients look at that number and go, oh, is that all? I thought it would be more. I'm fine with that. And then on the other extreme, I see the client's eyes bulge out, their face gets red, and they're like, oh no, that can't happen ever. I don't care what it takes. Help me prevent that. So it really depends on your appetite for paying taxes. So if paying a little bit of tax to reach that right amount of inheritance is what you want, no problem.
Right. And I think that what you were just mentioning, it really is all dependent on the appetite of the clients themselves. And I think that goes across the board with financial planning as a whole. The whole reason that we're here as advisors and planners is, while yes, to give those recommendations, but all of the clients are here as well, and they're just as much a part of these conversations. So being able to come to these conclusions together, and I can't stress enough how much everybody should be talking to their advisors and be open with their advisors with all of the different techniques and what they're comfortable with and what they're not comfortable with. So at the end of the day, what you ultimately are going to need is that peace of mind.
Exactly. And the best way to start is, if you haven't had it looked at in a while, ask your advisor to help with an estate planning review. And then the next step would be, okay, show me what estate tax exposure I have and help me see if I need to do anything about that. So that's a good way to start that conversation.
Exactly. Definitely. Now, here's one more quick question. Just at a high level, can you quickly explain the benefits of the SLAT versus the credit shelter trust?
Sure. The issue with the reason why there have been so many SLATs is the potential danger that the estate tax exemption might go down. So let's just say that on January 1st, 2022, the estate tax exemption goes down to $3.5 million, right? If you wait to do a SLAT until 2022, the most you can fund it with is $3.5 million. But now, today, you can fund it with $11.7 million, right? So if your estate is large enough, the reason for doing a SLAT as opposed to waiting to do a credit shelter trust is that you can capture so much more exemption now before it goes down. So that's the reason for doing a SLAT versus doing a credit shelter trust. That's the timing of when tax changes might occur.
That's great. There's a couple more questions here. Is there a way to fund an irrevocable trust with lifetime gifting while controlling when the beneficiary will have access to income and principal?
Absolutely. That's the beauty of setting up irrevocable trusts, is you can pretty much put any type of language or provisions in there that you want. It's funny, sometimes I get asked very specific questions by clients. Well, can I do this or can I do that? And I finally smile and I say, look, as long as it's not illegal, you can do it. So Absolutely, yes, Jude. You can definitely fund an irrevocable trust for children and then basically have it sit there and grow for a certain amount of time before they have access to it.
Sure. All right, I think we have time for a couple more here. Let's see. Now, would you suggest that each spouse have their own trust?
Own revocable trust or SLAT, or specifically what kind of trust?
Let's say revocable.
Well, I would definitely recommend considering a revocable trust as your primary estate planning vehicle. Mm-hmm. And the reason why I say that is if you don't have a revocable trust, then your will is going to be your primary estate planning vehicle. And the will has to be filed for probate. And depending on which state you live in, probate can be a costly, time-consuming process. And it's also a public process. Because anything that's filed in a court, anybody can see it. So that's the reason why we know all about Howard Hughes' estate is he didn't have a revocable trust, he had a will. So if privacy is important to you and just reducing administrative costs and fees upon death, then a revocable trust is definitely the way to go.
That's great. Let's see here. So here's a question that came in earlier, and I wanted to save this one for towards the end because I think it's a really great question, and it's exactly why we're here today. Is I always get so overwhelmed at all of the options for estate planning. The risks and benefits are too much to grasp, and you get paralyzed. How would you suggest we get past that?
Well, my question for you would be, to what extent have you tried to do it yourself and educate yourself? Because that's, again, what we're trained in the financial services industry to do is to demystify estate planning and to educate, based on how much you can absorb, right? So if you haven't leaned on your financial advisor, I would definitely recommend doing that. And just being very specific, it's like, look, here's what I want to learn and understand about estate planning. And then I want to understand how that applies to me. And really, rely on your financial advisor to help you do that. I mean, that's what our job is to make these things simple and understandable.
Perfect. Yeah, that's great. I think just relying on the resources that you have available, with your advisor, with any other financial services representative that you're going to be working with, utilize them as a resource for any questions that you have. Our jobs are here to be open and educating on all of these topics. Now, here's just going back on the SLATs. Are there any negatives to having a SLAT?
Yes, the two main negatives. I pointed out one of them, but I didn't point out another one. So let me give you more information on that. Obviously, the biggest risk is, Jane creates the SLAT for John in 2021. Everything's going well for 2 or 3 years, and then in 2024, John has an unfortunate accident and he dies. Well, Jane no longer has access to that SLAT because now the children are the beneficiaries, and she no longer has that indirect access. The other danger of a SLAT, and look, this isn't fun stuff to talk about, but I'm always trained to ask, well, what's the worst thing that can happen? Estate planning attorneys, that's how we're taught to think. The other thing that could happen that's negative is if Jane and John were to get divorced. Mm-hmm. In that case, Jane would no longer have access to that SLAT, and she would have basically given John that trust that he can now live on for the rest of his life. So, hopefully, it's a happy marriage situation and that's not a concern. But again, I'm just pointing out that what theoretically could happen.
Sure. So, on that same note, if a client or the advisor is afraid of a potential divorce, would you recommend, a Q-tip or a reverse Q-tip in lieu of a SLAT, or what would be the other option?
You're still talking about an irrevocable trust, and you're still talking about giving assets irrevocably to that trust. So the key is, again, doing a cash flow analysis to make sure that you retain enough assets on your own balance sheet so that you can live comfortably for the rest of your life. That's really the key, is not to give too much to an irrevocable trust, whether it's a Q-tip or a SLAT, So there has to be a balance.
Sure. No, that's great. So that seems like about the end of all of the questions that came in. So I just wanted to, again, thank you, Scott, for all of your time today, and thank you for educating all of us on this. And thank all of our attendees here on joining us today. From everybody here at Mariner, we thank you all.